I'm really looking forward now to the next and last point on the agenda today is a keynote presentation by our good friend Lobo Tiggre. He's with the Independent Speculator, founder, editor, publisher, chief idea strategist. I don't know, what do you call it? But that's, yeah, I didn't want to say that. And but I'm really looking forward to it. We filmed what was it called? A round table. I'm at loss for words. It's been a long day. But we filmed a round table earlier with Michael Howell as well. And Lobo's got some fantastic insights. I'm really looking forward to your takes on the commodities. You promised to cover a couple at least. So I'm looking forward to that. And where are we headed at the Deutsche Goldmesse, Lobo?
Okay. Thank you very much.
Thank you so much, Lobo.
So I just got to say, billions and billions of pounds of copper. I thought we were channeling Carl Sagan here. Sorry. All right. Kind of just quick poll. How many of you are readers already? Have any idea who I am? Oh, that's pretty good. Well, half? More? All right. Every time I speak or I write, I throw out whatever I thought I was going to say, and I try to say, what is the most important thing I can tell this audience or share with this audience right now? So I'm going to try to do that. It'll be pretty simple, be pretty short. Maybe we'll have time for some Q&A. And this is the Deutsche Goldmesse, so I've got a happy vibe here to share with gold bugs. Before I do that, though, I don't want to be coming across as another one of these perma bulls who's always pounding the table, buy, buy, buy. If somebody says buy, buy, buy every year for the last 15 years, it's not a particularly useful signal. So I want to point out that a year ago, well, Kai and I have been doing interviews for a while, but we've done one in New Orleans. And a year ago, I stood in front of a bunch of gold bugs, and I said my top highest conviction trade for the next year, 2023, is not gold, it's uranium. It's worked out pretty well. This year, I stood in front of that same audience, and I said, this time it's gold. So I just want to put that out there. I'll share with you why, but I want you to understand that I'm not the buy, 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 always buy. If there's some people out there, if it's never not a good time to buy gold, why am I, what new are you telling me? And I'll be more specific. This last summer, when you saw things rolling over, I put out a bearish call on gold. I said, I think we're going to see downside in gold in the near term. And before the new war, the new war, that worked out pretty well. And I'm not saying I always get everything right. I'm not saying I have a crystal ball and I can see the future. I've made plenty of mistakes. I've got plenty of things wrong. What I am saying is, like last year, the case for uranium was so compelling, and it was still below the cost of production, and the demand case was going through the roof, and even that great noted nuclear physicist Greta Thunberg was telling people in this country that maybe they shouldn't shut down their nuclear power plants. I mean, it was just an idea whose time had come. The fundamentals had been there for years and were getting only better. And the technicals were now agreeing. All the stars were aligning for uranium last year. There's no such thing as a sure thing in investing or speculating. But that was as close as you could get. I feel that way about gold right now. So, okay, gold bug likes gold. Where's the headline in that? What I'm telling you, though, is that I'm not a perma bull. I'm not just a bull. I feel extraordinarily bullish about where gold is going over the next year. So this isn't, oh, yes, it's going to $10,000 within our lifetime, you know, or even, oh, it's going to $5,000 by the time this crisis is all over and said and done. No, I'm being much more specific. In fact, I'm already on the record. I'm in team hard landing. I've made the case for recession, not just the global recession that's becoming pretty evident, I think, around the world. Here in Germany, you don't need to have me tell you about negative GDP prints. Sorry, no offense to my good German friends here. I'm just talking about the data. You know, team soft landing, I think, is an utter denial. And I kind of get it in the United States. The labor market seems to look good. The consumer keeps buying all kinds of stuff they can't afford. Everything's fine. But I'm getting off the initial point. The initial point is just please don't dismiss me as a perma bull. I'm not. As far as my case for gold right now and why I feel that it's as much as a no-brainer or as close to a no-brainer as it gets in resource investment, I don't know if I should stand behind here. I feel a little bit, anyway. I'm trying to have an honest conversation, open conversation. I don't want this thing between me and you, so here I am. The basic reason is the recession. Recessions are good for gold. Fear drives safe haven demand. This is not rocket science. You don't need me to tell you this. The main thing, though, is there really going to be a recession? So many people saw the recession coming last year, and they're all wrong. Team soft landing seems to be right, at least in the United States. Well, I don't actually think team soft landing is right. Now we have sort of these mealy-mouthed, smushy phrases, rolling recession, and oh, we have an earnings recession now, and then we're going to have this. I don't think so. I think we have a genuine distortion in the market. I think post-COVID and the difficulty people had hiring people and retaining people because of all the stimmy checks, making it quite profitable to stay at home and not have to work, still have all your video games on your big screen TV. I think it was really hard to hire and retain people, and companies have been really reluctant to fire people. And so people have jobs, people have money, they're still spending, things look good. But think about that for a second. If you're a company that's in trouble, and you're not firing people because you're afraid you can't get them back, you're actually digging yourself deeper into a hole. If you have more people than you need, if your business does not support your expense that you have right now, you're making your business less viable, not more. You're not making a good business decision in that case. And I feel for these people. I'm not one of these evil capitalists that wants to try girls to the railroad tracks on the weekend because it's so fun. I care for the people too. But it's better to fire 10 or 20% of your people than to go bankrupt and fire 100% of them, even if you care about people. So I think there's actually very serious trouble brewing in the United States. Now, the United States isn't the world. I get that. China's different. I get that. Europe is different. But as gold bugs, or commodities investors and speculators in general, these things are priced in dollars. So what the Fed does, what happens to the DXY, even if that shouldn't be the only thing that matters, it is a primary driver, and it affects everything that we care about in this room. So the US recession is not the only thing that matters, but it is very important to commodities investors and gold bugs. So I'm very bearish actually on the US. And if we look at the things, leading economic indicators, of which labor and unemployment are not, they're down for 19 months in a row. That is a screaming, waving red flag over the US economy. You also have federal revenues, which correlate strongly with recessions. They're down. You've got bankruptcies, which are up to 2008 type levels in the US. You've got savings plummeting. You've got credit card delinquencies soaring, because our consumer is so strong. You've got housing finally starting to buckle. And the housing market, you've got autos too. Housing and autos, those are Danielle DiMartino-Booth's favorite indicators. And they're cratering. You've got bank credit finally contracting. Long and variable lags. When you listen to the talking heads on financial media, they'll say, oh, well, we've had no recession for so long, there's not going to be a recession. And then somebody will say long and variable lags, and they'll say, oh yeah, long and variable lags. But there's still no recession, so moving right along, everything's fine. The average delay of these long and variable lags is 22 months. My good friend Adrian Day has done the math on this. We're just getting there now. So all these people that you see on Bloomberg or whatever saying, oh, it's been 2 years, there's been no hard landing, so there's not going to be one, everything's fine. They're actually completely ignoring the track record. The track record is we're just now getting to where the average would start to show up. And on top of that, we had these labor hoarding and other distortions that might postpone it more. So we might still see the consequences of truly unprecedented Fed tightening not show up for a while. But I think they're starting to show. One of my favorite charts, I don't have a whole bunch of charts here because, like I say, I want to be relevant and I want to say what's happening now when I step up to the podium. But one of my favorite charts, you can pull this up on the Fed or any place, is the long-term unemployment chart. And it comes with gray bars for recessions. This is like 50 years of unimpeccable data, like no exceptions, 100% rule. And every time you have recession comes after the unemployment turns up. It turns up into the recession. And right before the recession is when you have lows in unemployment. So you have all these talking heads. These are serious, supposedly, financial professionals on Wall Street, a parade of them coming through Bloomberg, Yahoo Finance, CNBC, all these places. And they're saying, oh, we've got near record low unemployment, so there's no recession. That's actually the opposite of what the data tells us. And this isn't even my anarcho-capitalist, libertarian, optimistic. This is the Fed's data. The government's own data says unemployment goes down, 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 and then curves up into the recession. So, the most optimistic data you could possibly get, the government's data, is telling us that we're at that inflection point now. So, I'm not going to say, therefore, gold's going to a new all-time high tomorrow, next month, whatever. I'm not going to pull out that crystal ball that I just said I didn't have. I'm saying that to quote our great guru, Jerome Powell, the totality of data, not the hand-picked, cherry-picked one or two little data points that Team Soft Landing likes to hang their hat on. The totality of the data is not just indicating recession, it's screaming recession. Key indicator with flawless track record or highly correlated track record, one after the other, they're all screaming recession. And okay, China's different. I was just talking with Michael in our interview. China has the great advantage if they want to spend all kinds of money, billions of dollars on new infrastructure, they actually have the money in the bank. They don't have to print it to do it. They can just spend it. So yeah, I get it. China's different. But if China's the factory of the world, what happens to that factory if the world is no longer buying? If Europe is already on the skids and the US is visibly heading there, how does China continue to sell to everybody who isn't buying? So, sorry, I just don't buy the China's going to save the world thing. There are a lot of people that remember recency bias. They remember that China helped us come out of the GFC. I don't see it this time. I don't think China's going to save us all. I think the world is in a deepening global recession. I think the US is too. I think that will become undeniable soon. I said earlier this year that I thought that would be undeniable by the end of this year. I get that I don't have a lot of time left to be right. Could still be, if we're at that inflection point, I could still be. But if not, if it's Q1 or Q2 next year, that isn't going to matter to you as gold investors or commodity speculators. It's still coming. I think your payday is coming, and I think not someday, somewhen. I think in the year ahead. And the best news about this is, for gold bugs in particular, is that the gold stocks are now almost as hated as carbon was a year ago, maybe, or uranium a couple years ago. I mean, you can't give these things away in some cases. And it's not just crappy little juniors, sorry, that's a technical term. Even major producers are trading on the low ranges of their, in some of them, if you price them in real terms, and real terms doesn't mean inflation-adjusted dollars, it means in gold. If you price the producers in gold, many of them are at or near all-time lows. So in a case where, A, you have gold at the sorry low price of plus or minus $2,000, and you have the macro setting, which screams higher gold prices going forwards, and you have the stocks that offer you leverage to gold still on sale, that's a fantastic setup. And on top of that, the cherry on top of the cake is that we have this setup. We have this discrepancy between price and value in the stocks going into tax loss season. US tax loss season starts like next week. It peaks in a couple weeks. And you've already got a whole bunch of stocks that are at or near 52-week lows, or at least on the low end of their 52-week range. Those are prime candidates for tax loss harvesting, even for people who like the company. By US tax rules, they can sell them in December, wait 31 days. They like it, try to buy back in again after harvesting a tax loss next year. So it could be sort of the best of all worlds for the gold speculator specifically, that you could have fantastic buying opportunities coming up in the weeks ahead. This may sound like I'm just another gold bug. This is why I started the way I did. Oh, there's another gold bug saying buy, buy, buy gold. I am rarely this excited. For me, this is excitable. This is me jumping up and down, pounding on the table by Lobo Tiggre standards. I'm excited. I mean, this is a key opportunity. I have been building cash in my brokerage account for the last couple of months because I am expecting to have some spectacular buying opportunities. And like Santa Wolf, I'm making my list, I'm checking it twice, and I'm excited. So I want to share that excitement with you. The flip side of this is, and I know this is Deutsche Goldmesse, but I was asked to talk about commodities. This has implications for the rest of the commodity suite. If I'm right about the recession, this is bad news for industrial metals. And sorry, platinum bulls, I know there's one or two of you in here, long-suffering platinum bulls. Platinum is an industrial metal. You can call it precious if you want to. It certainly is expensive, but its price and its demand in the world is driven by auto catalysts more than anything else. Nobody can tell the difference between a platinum ring and a silver ring, so you might as well get silver, it's cheaper. Like, nobody substitutes platinum for silver. Here, I'm going to sell you some silver here, and it's really platinum. It doesn't happen, right? These silvery metals, of the silvery metals, silver is the cheapest one that looks like silver. That's a big, who the heck even knows what palladium looks like? It's another silvery metal. These are not monetary metals. They're industrial metals. So if I'm right about the recession, I don't want to buy any industrial metals, no matter how precious. And by the way, after the recession, I'm a huge copper bull. It's not just the electrification, it's Dr. Copper. And when the world comes out of this, and it will, there's no question that copper demand goes up. And then on top of that, you have all the EVs and all this other stuff. So it's just sauce for the goose. I'm a huge copper bull. But it's Dr. Copper in front of a recession. If I'm right, copper goes lower, copper stocks get whacked twice as hard, 5 times as hard, or whatever. This is not a time to be buying industrial metals, in my view. Sorry to anybody in the other room who's in industrial metals. But maybe Kai won't invite me back next year for saying this, but I wouldn't touch them with a 10-foot pole. Now, it doesn't mean I don't like them. Doesn't mean I won't research them. Here's my handoff to Kai. I want to go out and find who's the best guy in the other room for when the recession is just decimating that sector. I want to be a bottom feeder at that time. And the good news is, even for these guys, perhaps, if they have cash in the bank, if they're out of cash in the bank, but if they have cash in the bank to endure the downturn we're about to go through, A, spectacular buying opportunities. B, I think the government response to what I'm talking about is going to be huge, fiscal and monetary. We're not just talking about a Fed pivot here. We're talking money helicopters, money bazookas, money floodgates, everything we saw in 2020. We have now established for the world that no fault of their own is a perfectly adequate reason to send people checks in the mail. They happen to be voters. That's a pure coincidence. But we can just send people checks in the mail because anything bad that happens that's not their fault is enough excuse to send them free money. Why not? We can just print it. It's like Doritos. Eat all you want. We'll make more. Sorry, that's an American reference, but anyway. So I'm actually saying that in a backhanded way, the recession is very good news for industrial metals because I think the fiscal and monetary response is going to be outrageous. You think that 2020's response was ridiculous. We thought that was ridiculous compared to 2008. I think what comes next is going to be even more ridiculous. And you've got China trying to reboot. The writing is actually on the wall, I think, for a commodities super cycle for the record books, but not until after the recession. We go through the ringer first. And I got to say, there is a non-zero chance. I'm not promising doom and gloom and Mad Max, the end of the world, but there is a non-zero chance that the powers that be actually lose control. Like if they open the money floodgates and they try to do all this stuff and it doesn't work, you get hyperinflation and chaos. And I don't know how that happens and how that plays out. I'm not saying that will happen. I'm just saying it's something to worry about. And I'm saying it's another reason why I want to buy gold. I want to speculate on the gold-dollar exchange ratio with the gold stocks. But I want to have gold, physical gold, that I can hold in my hand, stuff it under the mattress, sleep on the lump, so that I can sleep while not worrying about tail risks and what might be the worst possible thing. Always remember, gold itself is insurance, it's safety, it's savings, it's not a speculation, it's not even an investment. So this complaint that gold doesn't pay interest, that's silly, it's nonsense. It's not why you own gold. You own gold because it is what it is, and it has value no matter what. One good suit in Rome, one good suit today, the value is still there. So, takeaways. I'm uber bullish on gold, not just because Kai invited me here. I'm uber bullish right now at this time for these circumstances that I've outlined. And I see spectacular buying opportunities. And not someday will, the great pumpkin will come and save us. But like in the year ahead, I think we get paid. And the fact that we have this buying opportunity going into tax loss season now ahead of that, I think that's spectacular. You rarely have that kind of, I think, clarity coming ahead of a short-ish time frame for an investment thesis. Remember, copper and oil, by the way, falls in the same, oil gets whacked. If you go into a recession, the energy sector, it all sells off. The one exception would be uranium again. And I just said that last year my highest conviction trade was uranium, not gold. This year my highest conviction trade is gold, not uranium. But this is hot off the presses. This is brand new. I haven't even put this out to my readers yet. I'm looking at the news flow over the last couple of days, and uranium headlines are really starting to break out. I mean, this is literally hot off the presses today. The $80 uranium price has really got mainstream people starting to chatter about it. You see Bloomberg, CNBC are talking about uranium. Yahoo Finance, all they want to talk about is AI and Chipotle or something. But they're talking about uranium suddenly. So I want to be careful here. I'm not saying, buy uranium, it's going to the moon tomorrow. That's not what I'm saying. In fact, I think $80 uranium is enough to begin to bring a lot of mothballed supply, and pounds that were bought at $18, $30, $50, those same pounds can now be turned around and sold at a profit. So I see an unknown secondary supply question in the year ahead. But for whatever it's worth, if we're going into a flavor of the day phenomenon, like uranium could become the next meme stock. It's not a promise, it's not a prediction. But I will say that if I didn't own any uranium stocks, I would want to have at least one little finger in the pie ahead of that possibility. And I haven't said too much about silver. How many of you are big silver bugs in here? Is Keith Neumeyer in here? I'm about to piss off Keith Neumeyer. I'm not anti-silver. I've been called Darth Silver because I've been talking about the changing use case for silver. I like silver. I have plenty of silver stocks. But the data, not me, not Darth Silver, the data says that silver is starting to act differently from gold. In 2020, we saw this big crash, the COVID crash. Gold comes screaming back up, and silver kind of went, I'm falling and I can't get up, right? That was the first time in 50 years that silver never caught up with gold in a bull market. Something changed. So I get it. Silver is the word for money in many languages. I understand. I don't hate silver. I'm not anti-silver. Just saying the data tells us that silver's starting to act different. And at least the COMEX traders, the people whose futures trades we mistakenly refer to as the price of silver, those people don't care about the word for money or the history of silver, all that. They don't care about any of that. And most of those people are looking at silver as an industrial metal. And over the last year, we have frequently seen silver trading. You can see it, the wiggles in the charts. It looks a lot more like copper than gold. So not anti-silver. I'm just saying I wouldn't bet the farm on silver outperforming gold this time. It didn't last time. It may or may not the next time. It no longer has an unbroken track record of catching up and passing beyond gold. So I like silver. I own silver stocks. I'm just saying, don't be a silver fanatic, please. If you love silver, please just make sure you have a gold lining to your silver story. At least that, okay? You don't want to bet everything on that. And finally, if you get a flavor of the day environment, or you get gold hitting new all-time highs, and by the way, at plus or minus $2,000, a 10% increase in gold gets you to a new nominal all-time high. That's not a big swing. It really doesn't take much from where we are. But if we start seeing that sort of thing where suddenly there's risk of World War III and people piling into safe haven assets, and it could be gold, it could be the other yellow metal, But if one of these things becomes a flavor of the day, you don't want to miss that ride. You don't want to be the greater fool who chases it, but you want to be positioned in front of it. So I think that's pretty much it. My message is definitely look at the gold stocks during tax loss season and have gold for safety and security. Have silver too, but don't go crazy about it. And consider the other yellow metal. That's it. Do I have time for questions? Or?
I'm just going to grab a microphone.
Sure. Okay. here I am. I'm happy to. There's a fellow in the back. Yes, sir.
Well, I have a question about.
Hold on, Ray. Coming. Thanks.
Well, I have a question about the central banks. We see them adding now for a couple of years, but I wonder where is all the gold coming from then? Because we don't see that spectacular move in the gold price already. It keeps under 2,000 still, and they're adding a lot. So you should expect the price is increasing then.
Yes. Well, let me tease apart two things. Where is it coming from? I can tell you where it's all coming from. I find it very interesting that the PBOC is adding gold at the same time they're the world's largest gold producer, and at the same time they don't export. And then they report these anemic gains. So I think central bank accumulation is probably greater than reported. And remember, the World Gold Council puts out these numbers. Where do they get that information? The IMF. Where does the IMF get that information? From what the countries say. You trust these governments to be honest? I don't. So on the other hand, this lends itself to incredible stories. The central banks are buying gold, it's going to the moon. Well, it hasn't gone to the moon. And the central banks are going to do a gold-backed, BRICS currency. Didn't happen, right? So I'm reluctant to get too excited about some of these big idea stories that they're unprovable. You'll never know until hindsight, if any. But the other part of your question I think is very interesting, and I would actually say that, to my mind, $2,000 gold is not a disappointment. I think $2,000 gold is a huge overperformance in the face of much higher real rates, a higher dollar, and the war's not turning into World War III. There are a lot of headwinds for gold right now. In real rates, they haven't been as high a correlate as they have historically, but since the gold-dollar ratio was freed to trade in 1971 by Tricky Dick Nixon, the single highest correlate for gold has been real rates in the US. And the real rate has been a major headwind for gold lately. Even just the turning point should have been knocking gold much down, by historical terms, the turning point, the change of direction should have knocked gold much lower, but it didn't. And the record blistering pace of 550 basis points should have knocked gold much lower, but it didn't. And I think the central bank buying that you're putting your finger on is a large part of why. So I think we would be looking at much lower gold-dollar exchange ratios absent the buying you're looking at. So it's not like the market didn't notice or it had no impact. Does that make sense? Okay, other questions? I think I got a late start, so I think I do, despite this, have another minute or so.
Oh yeah, definitely.
Billions and billions.
Especially billions and billions, especially given your view on the future economic growth in the near term, lithium.
Okay, so I was a late bull to the lithium story, but it is industrial. So we put out a free lithium report you can download. We have one on uranium, we have one on lithium, we have one on nickel. The lithium one was bullish, but not till after the recession. Like I was thinking about this coming, and boy was I right. Lithium's down 75% over the last year, or is it year to date? I forget, but it's way down. I don't get everything right, but the good news there is that same report says, okay, I'm not buying ahead of the recession, but afterwards I'm very bullish. And there's a couple things here. One is, okay, lithium's not rare, but the people who know how to do these brines are. And the hard rock projects, it's not like copper or gold where what you get is just the metal, right? The chemistry in each is a little bit different. It's not one single technology that produces them all. They're tricky. So economic lithium is quite another matter. And while the world builds out the fleet, I see the case there. So where I'm going with this is, and yes, people are talking about hydrogen cars or other things. Lithium might be the Betamax, or it might be the VHS, if you follow the metaphor of today's battery. It might not be the best batteries, but it's the dominant one. So that's not going away. If hydrogen eats lithium's lunch, it's going to take a decade or more. So very bullish after the recession, but then we just got to see for how long. I think we have supply issues. lithium itself isn't rare, but the right people, the right deposit type, in the right place where you can get permitted, all the stars. I do see supply constraints and higher lithium prices after the recession. But it's not like copper, where I think it's going up for decades. I think there gets to be a point where you saturate the market, other technologies might take over, you train up new people, you start uncorking the bottlenecks. But I do see a rebound after the recession. Yes, sir.
So I just want to combine two things. So we're agreement that at 2000 gold, it's pretty good and it's holding up, while the juniors and the majors are in a very tough bear market. And I think it's good feeling, I didn't check the data, but in the last few times that everything is selling off, macro-wise, the big ones, all the juniors and our sector is also following. So if there's coming a recession, why would it be different this time that the juniors wouldn't see another big sell-off?
Okay, a couple levels. I get the question. One thing is to distinguish between a major waterfall event in the markets, a crash, like the flash crash of 2020 or the big crash of 2008. That's different from just a recession. And a broader market, bear market, grinding down 20%, keeps going lower for years, that could happen. And that doesn't have the same impact as one of these waterfall events. So in that type of recession, and it could go either way, but let's say there's no big market crashes, just turns bearish and the economy goes down and the governments throw money at it, but it takes time to turn around and it's just kind of miserable for a while. In that environment, gold could be one of the, gold and uranium, it could be one of the few things that's a bright spot. So the very fact that the market is turning south could actually squeeze money into the gold sector, because what else is working? Or gold and uranium. So I don't take it as a given that a recession would necessarily take gold stocks down. A crash takes everything down. And then, if we are so lucky as to get like a 2020 style event, and then they throw the money at it and everything comes screaming back, that you would want to be liquid for one of those. You want to never go all in. So that's one thing. Distinguish a flash and a crash. And the other thing is, and distinguish between the larger players and the juniors, which you sort of did in the question. They're different things. If you've got your go-to stocks in the space and they're making money, they're printing cash at these prices, and whereas the junior is still exploring moose pasture, there's every reason for money to flock to those go-to names. That's why we call them go-to names. Gold's up. Well, what am I going to buy? Well, there's the few stocks that everybody knows, household names. That's where the money goes first. The juniors, they'll take a while. Maybe nothing happens in an environment where people are nervous. They'll go to the go-to stocks. They'll hesitate about these until maybe the takeovers start happening. They're significantly different markets, what I'm saying, between these layers. Have I answered your question? I'm not sure I did.
It makes sense.
Okay. All right. Am I out of time?
You are out of
All
time.
right. Okay. All right. Well, thank you very much.